Hello and welcome to this session. In this session, you will learn about the structure of capital markets and the different asset classes available in the capital markets. So let's begin. What is the capital structure of a company? Let's take an example. Let's say I want to start my own online e-commerce solution for all possible needs of buyers. This could include making an appointment with electricians or carpenters, car wash requests, or ordering groceries or cosmetics. Basically, you name it, and my site should offer a solution to your request. The investment is limited to the technical aspects of the website. To an extent, we need a marketing team and an administrative team. But for my venture to take off, it all boils down to a huge initial investment. So I invite all my friends to be a part of this futuristic idea and pledge monetary support. Make note that I am not asking for a loan. Rather, I am offering you partial ownership of this business. Your investment will not only make you a part owner, but also an active manager of the business. That is, you would make important decisions related to the company's operations. The extent of your ownership will be dependent on the percentage of your investment against the total capital required for this venture. You earn returns in the form of profit, and your returns would be in proportion to the company's performance and profit. Bear in mind that if I take loan from you, I will not allow you to interfere in the day-to-day business of the company. Rather, you would be paid only the regular interest amount agreed upon. In the long run, once I pay off your loan completely, you will not be a part of this company. So what are we talking here? We are talking about debt here. Share capital is the owner's contribution to the company. You share the risks and the benefits associated with ownership. The extent is limited to the owner's contribution only. It is quite possible the business is a hit and we make plenty of profit compared to the steady interest component that you would earn otherwise. Likewise, there might be times of losses. In this case, the owners don't make money either. On the other hand, debtors who have lent a loan to the company are still entitled to their interest payment, regardless of the financial results of the company. This is the major difference between a share owner and a debt or a bond owner. An organization's capital requirements would determine the capital distribution pattern. Now, is the fund required to meet its day-to-day operations? Or is the need more long term in terms of plans for expansion, diversification, or even new buyouts. Short term fund requirements are generally funded by banks in the form of loans or overdraft facilities. If the organization is looking for short term funds, then the capital markets are not the place to raise the required capital. To raise long term funds, a company can either issue equity stock or interest bearing bonds. In this module, we will focus on and understand equity in more detail. But just like any other market, the capital market also offers a host of products to suit the issuer's need and matching the investor's risk appetite. Risk appetite can be defined as the amount and type of risk that an organization is willing to take in order to meet their strategic objectives, and this would depend on the type and choice of products chosen. Companies have various types of instruments at their disposal in order to raise funds. These products are varied and complex in nature. Broadly, these instruments can be classified either as equity or debt. Equity and debt have several forms of derivative instruments which can either be exchange traded or OTC, that is traded over the counter. Exchange traded derivatives include futures and options, while OTC derivatives include forwards and swaps. We have now reached the end of the session. Thank you for your time.